So, seeing the economy on the verge of collapse, I did the logical thing. I sought to profit from it. Specifically, I set out to buy credit default swaps on subordinated tranches of subprime residential mortgage-backed securities. And that's where I lost my investors too. In fact, in doing so, I gained a new level of insight into how Wall Street really works. I called different Wall Street firms, banks with which I had prior relationships due to my trading of distressed debt. I tried to convince them to trade in this market with me. Initially, I found no takers. This was March of 2005. The whole effort was complicated because it was important to me that this security, this instrument that I'd like to use to short the market, would be standardized such that if I bought a credit default swap from one dealer counterparty, I could easily trade that credit default swap to another dealer counterparty. Bespoke, one-off contracts were full of contract and counterparty risk that I would not tolerate. Nevertheless, by May of 2005, standardized contracts were on the cusp of becoming reality. In May of 2005, May 19th of 2005, we agreed to our first trades shorting the subprime mortgage market with Deutsche Bank. We worked on these soon-to-be standardized contracts a bit, and in the first days of June 2005, the first trades that officially went through. We would ultimately use 9 different Wall Street dealer counterparties. To be clear, well, first I'd say Lehman and Bear I avoided for obvious reasons, even back then. Goldman Sachs featured very prominently early on. They were a very anxious crew. To be clear, these credit default swaps that I'm buying would rise in value as mortgages are written off and the value of these tranches fell. Goldman Sachs in the spring of 2007 appeared to us to want to make its trade bigger. They wanted a bigger piece of the big short. A lower price, therefore, would benefit Goldman Sachs, and that's how Wall Street works. In late of June of 2007, credit spreads started marching higher, and then they just took off for once Goldman was on the same side as my trade. Then it was AIG's turn to complain about Goldman's marks. Incredibly, it would later be reported that more than $60 trillion in credit derivatives were in effect at the peak. Now, hyperbole would say that is more than the gross product of the world. But it's roughly equal, and who really knows what the gross product of the world is? How could that be? How could it even get close to the gross product of the world? Credit derivatives on an underlying asset could be worth multiple orders of magnitude more than the asset itself is worth, because all asset-backed securities, all asset-backed derivative securities settled in cash, pay as you go. That was the secret sauce of the doomsday machine. And so the crisis unfolded, with the market providing a signal far too late. Even so, Fed Chairman Ben Bernanke, Treasury Secretary Hank Paulson continued to underestimate the situation. I was just like that, apoplectic. Secretary Paulson now claims that even if he knew what was going to happen, he couldn't have done anything about it. May be true. After all, he would say, I just joined the Treasury in the summer of 2006. But he came from the top CEO job at Goldman Sachs. And once Treasury Secretary, he wasn't so impotent. He orchestrated the once unthinkable government takeovers of AIG, Fannie Mae, Freddie Mac. Absolutely unthinkable just a few years ago. The bailouts of Wall Street. He was anything but an impotent tool. And he had a running start unlike any other. But if he truly felt that way, this is an absolutely devastating commentary on how our government works. In fact, as books and articles on the crisis proliferate, it becomes clear that at nearly every failed institution and every relevant department of government, there was someone whose insight was every bit as good as mine, and in many cases better. However, none, zero were in the top job. That our CEOs, our governors, our presidents, and our chairmen did not see this coming, did not adequately prepare their constituencies, is an indictment of the manner in which we choose and enable our leaders. But such would not be the conclusions in 2008. Broadly speaking, it's the hedge fund's fault. By the second half of the year, with the government targeting commodity hedge fund managers with punitive subpoenas, the global attack on so-called speculators and evil hedge funds, the nationalizations of Fannie, Freddie, AIG, etc., and their liabilities, very importantly their liabilities, which are now a special purpose vehicle of the government. TARP. I worried about the future of a nation that would refuse to acknowledge the true causes of the crisis. In my view, an historic opportunity was lost. America had instead chosen its poison as its cure, and the second greatest generation would never be born. Today, I expect the U.S. government to attempt to continue easy money policies into the next presidential term, past the meat of the foreclosure crisis, and past the corporate and public refinancing humps that are upcoming. With junk bonds incredibly are again at all-time highs. Quantitative easing seems to be working for now. But this is an invalid validation of what America is doing. This is, in fact, a Pyrrhic gamble. As we continue to debase our currency, Bernanke says he is not printing money. Again, I disagree. As it stands, I get an email every single day from the Fed saying we just bought another 7 to 8 billion of treasuries, monetizing the debt. I don't know, that's pretty clear to me. In fact, this program, QE2, not Queen Elizabeth, quantitative easing, QE2, its scope and breadth raises a severe question of the Treasury's needs. The government's borrowing of money for the purpose of injecting cash into society, bailing out banks, brokers, and consumers is a short-sighted, easy decision for a population that has not yet learned that short-sighted, easy strategies are the route to long-term ruin. We never quite achieved the catharsis necessary to stoke a deep reevaluation of our wants, needs, and fears. Importantly, the toxic twins, fiat currency and an activist Fed, remain firmly entrenched, even more so with the financial reforms last year. In fact, the Federal Reserve, having acquired new powers of regulation, has insisted specifically that nothing in the field of economics or finance was of any help in predicting the crisis. Period. No more comment. It's a worthless conclusion. It guarantees we'll make the same mistake again and again. So I have a problem with leaders. I should note, yes, I've been very overwhelmed by these mistakes they've made. We need better leaders. But very frankly, this isn't going to happen. A problem cannot be solved if it can never be acknowledged. And I don't see acknowledgement happening. Taxes need to be raised, spending needs to be cut, loopholes need to be shut. If we are to have any hope of returning to a stable base. Certainly, home ownership should not be a policy of the U.S. government. And the banking system needs substantial reform and even bank breakups. Glass-Steagall needs a second run in a strong form. And those 22.5 million public workers have no business unionizing against the taxpayer. The list of things that won't happen but should happen goes on and on. As citizens of these United States, we should carefully consider what 1 trillion means. All personal income taxes collected in the U.S. in a year do not add up to $1 trillion. By 2020, interest expense on our national debt could very well exceed $1 trillion. When you consider our $1.7 trillion deficit, consider we really only take in a little over the Treasury's inlays are only a little over $2 trillion. It's quite a loss margin. $2 trillion also happens to be a little less than the amount of bank and government debt now held at our overly bloated Fed. 2 trillion seconds is 64,000 years. And what's minimum wage again? Our country's math is scary big, but even more scary is that it simply does not work. Speaking of math not working, how many of you are checking that math? Pretty sure 64,000 years. So arguments on blooming economic recovery must be considered alongside the fact that all this debt and all the money being printed is very much a real bill, a real tax on our future. It's debtor's prison for our children. It has not yet come due today except for savers and those on a fixed income. As such, I recommend sober analysis on the part of the individual. This is paramount. We must remember that entire societies can and do follow the wrong path for a very long time. They do run aground. And there's nothing wrong with breaking from the social norm to ensure good outcomes. Legacies are a terrible and sometimes fatal burden in a rapidly changing world, and common sense must rule when it comes to career paths and life choices. Though the situation seems to call for it, it is not a time for a responsible individual to tolerate any level of blind faith directed toward any man or woman. It is absolutely not a time to follow. So all that said, I might recommend opening a bank account in Canada.